webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar, which is a live question and answer session. Because this is a live question and answer session, things will work a little differently today. For those of you who haven't participated in this kind of webinar, we will tell you how you may submit questions during the webinar in just a few minutes. The webinar will last approximately 15 to 20 minutes, and at the end, you will be provided with our contact information so that you can request more information about the topics that we discussed today. For today's webinar, Lennis and I will both be answering your questions. Lennis worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Lennis also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg. And Lennis regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available for sale. For more information about this book or Lennis's other books, please feel free to contact me. I am Jennifer Lawler. I joined the Advanced Underwriting team in October 2014. Before joining the team, I spent 6 years working for a tax and estate planning group, where I worked extensively on tax return prep, estate planning, and assisting clients with all of their tax needs. Now I'm going to turn it over to Lennis, who will give you more information about submitting those questions.
Well, thanks, Jennifer. I appreciate that. Before we get to information about submitting questions, let's decide on what next month's topic is going to be. We've got 3 choices, and we'll open the poll in a second. But the 3 choices are ethical issues with incapacitated clients, captive insurance arrangements take another hit, and also dealing with terminal illness. I'm going to go ahead and launch the poll. And it is open. You may cast your votes. Please go ahead and take about 10 seconds for that, and we'll wrap that part of this up. If you haven't voted, please go ahead and vote. All right, just take another second. And next month, we will talk about captive insurance arrangements and them taking another hit. So thank you for participating in that. So let's talk about today. Let's visit about how this is going to work. Jennifer and I have a couple of questions that we've gotten prior to today's session. But if you have a question that occurs to you that you would like us to address during today's session, what we'd like you to do is we'd like you to type it in the questions window, very much like you participated in the poll. The questions window is just below the poll window on your GoToWebinar interface. Type your question in the question window and hit send, and we will address your question during the webinar, assuming that we have time. So let's go ahead and actually deal with a couple of the questions that we'd gotten prior to today's session. The first question, which was submitted prior to the webinar, is this one. Frank requests a $50,000 distribution from his traditional IRA account on September 16th. The request is processed by the custodian on September 19th, and the custodian mails the client a check. The check arrives in the client's mailbox on September 21st, and the client deposits the check at the bank on September 23rd. And so the question is, what's the 60-day rollover deadline? And I guess prior to getting to the 60-day rollover deadline, what I would ask a caller, if a caller called in with this fact situation, is I would ask who the check was made out to. The IRS has said that if a check is not made out to the client, but instead made out to the new custodian, but the check is mailed to the client, that it's not really a 60-day rollover at all. It is in the nature of a trustee-to-trustee transfer or a direct rollover, depending on the source of the money. But it is intended to be a direct rollover where the client's not handling the money. So there is no 60-day deadline. The only thing the client can do when the client gets the check is to give it to the new custodian. The client doesn't have the ability to negotiate the check at all if the check is made out to the new custodian. So we don't have a deadline, at least according to the tax code. Now we may have a practical deadline because the new custodian won't accept the check after a period of time has passed. But that's a different issue, and that would be something that would need to be sorted out between the client and the custodians later on. But the 60-day deadline does not apply in that situation. Now, if the check is made out to the client, this fact situation is, the dates are really kind of important. The IRS has taken the position that the 60-day runs from the time that the client receives the check. And at least according to a recent revenue ruling, the check is received by the client when it comes in the mail, when the client takes physical possession of the check, not when the client deposits the check in the client's bank account. And so in this case, the relevant date is September 21st, and so 60 days after that would be November 20th. That would be the deadline when the client has to have redeposited the funds within an IRA or other qualified account in order to do a valid 60-day rollover. We sometimes get calls from producers who say they have instructed the client not to cash the check. That doesn't really help if the check is in the client's possession. Well, the follow-up question is usually something like, well, how's the IRS going to find out? Well, they'll find out when they come and ask. And the client, if the client fesses up the time the check came in the mail, then the client's got 60 days from the time the check came in the mail rather than the time the check was deposited in the client's account. And so that's kind of a full analysis of that kind of circumstance. Of course, people always seem to surprise us with new variations on the fact situation. So if you run across something like that, we're glad to visit with you about the rollover deadline. Let's go ahead and shift to the next question. This one's going to be for Jennifer. Jennifer, this one came obviously before the meeting as well. And the question is, if I have a client who's receiving Social Security benefits and the client is subsequently imprisoned, doesn't happen often, but it does happen, will the inmate lose his benefits? You want to address that one?
Yeah, thanks, Lennis. So the answer to this question will depend on a couple of different factors, such as how long the person is in prison and what type of benefits they are receiving. For instance, the Social Security Administration will not pay Social Security disability or supplemental Social Security to incomes or to individuals that are incarcerated. So there's no time limit on that. If they're incarcerated, their benefits will stop. If if it's a short period of time, less than 12 months, their benefits can restart at the month following their release. But if they are incarcerated for more than 12 months, they have to go back through the qualification process to qualify for Social Security disability or supplemental security income. Those are benefits that are a little bit harder to qualify for. You have to prove your disability and that it is ongoing. And then with the supplemental security income, that's typically for people who are, low income, and you have to prove that you're low income. So those benefits can be harder to get back if you're incarcerated for more than 12-month period. But if the person was receiving regular retirement Social Security benefits, the Social Security Administration will suspend those payments if the person is convicted of a criminal offense and is in jail for more than 30 consecutive days. But if that individual has family members, a spouse, or even children that are receiving benefits on that worker's record, those benefits will actually continue even though the worker's benefits have been suspended. But again, when the individual gets out, their benefits can be reinstated the month following the month of their release. So regular Social Security benefits are a little bit easier to get back, reinstated than those other kinds of benefits are. This is a question that people don't run into very often, but it is a question that's been asked to us on a couple of different occasions. So it's good to have in your knowledge bank if something like that ever comes up.
Perfect. Thanks, Jennifer. So as a reminder, if you have a question that you would like us to address live today, please type your question in the questions window on the GoToWebinar interface. We'll be glad to deal with it. I think we've got one question for you, Jennifer. You want to answer that one?
Yeah, so I was recently asked about a QDRO, or Qualified Domestic Relations Order. As most of us know, when you have a client that receives part of a employer plan because of a divorce through a QDRO, then they can access those funds that they've received because of the QDRO, or the Qualified Domestic Relations Order, without the 10% penalty when they're accessing them from that plan. So this QDROs apply to, like I said, qualified employer plans such as 401ks and 403bs. But the IRS has said that when a person receives, a part of account because of a divorce, that they can access that part of the account without that 10% early distribution penalty. The question that was raised was, does that exception to the 10% early distribution penalty also apply to the person whose account was split? And in the fact pattern that this question was asked in, it was a wife whose 401k, who had an old 401k plan. She was no longer with that employer, but she had left her plan with that employer. It was split 50-50 between the husband and wife. The rep that I talked to was asking on behalf of the wife, it was originally her plan, but could she access her funds that were left without the 10% penalty because there was a quadro or a qualified domestic relations order involved. He was hoping that she could because she had some outstanding expenses from the divorce as well. So we did a little bit of research on it, and unfortunately for her, the answer is no. For those of you that are interested, this exception can be found in the Internal Revenue Code, Section 72C, Section 72T 2C. It tells us that the exception only applies to the alternate payee. So that's the person who is receiving the funds because of the quadro. So the person who originally owned the account, unfortunately, does not get this exception. It only applies to the person who is receiving the account and not the original owner. So the original owner, in that case, if the original owner were to access the funds, she would have been subject to the 10% early distribution penalty.
Yeah, excuse me, Jennifer. Just when we think we've answered every question, there possibly is somebody comes up with a new one. So thanks for sharing that. So if you have a question, go ahead and type it in. I don't see any in the queue currently. And so what we'll do is we'll start to close the session, but if you do have a question, we will address it after we kind of finish our closing method, and if we don't, then we'll just sign off. So Jennifer, if you'd tell the folks a little bit about our service, that'd be great.
Yeah, thanks, Linus. And thanks for joining us today and submitting your questions. As a reminder, if you would like to receive materials about the topics that we've talked about today, you can email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also, email us questions related to the webinar. So if you have, follow-up questions about the things that we've talked about, feel free to email me. And finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultations, newsletter licensing, please feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.
And I see we have no questions in the window, so I'll add my thanks for attending today, and we will talk to you all next month.